How do you know what a company owns? You can find out by looking at its assets. But what exactly is an asset? An asset is something that a company owns that will provide a financial benefit in the future. Assets can be found on the balance sheet. The balance sheet is one of the three main financial statements, the other two being the income statement and the cash flow statement. Assets are listed in their order of liquidity. Liquidity meaning how easy it is to convert to cash. Cash is already cash, so it comes first. Property and equipment is harder to convert to cash, meaning it is less liquid, so it will come later. There are two main types of assets, current assets and non-current assets. Current assets are things which are expected to be converted to cash within the next 12 months. Non-current assets are things which are not expected to be converted to cash within the next 12 months. Let's start with current assets. Current assets are important because they help with the day-to-day operations of the business. Current assets include things such as cash, cash equivalents, marketable securities, accounts receivable, inventory, and prepaid expenses. Cash is pretty self-explanatory. It is physical cash and coins, but also money in the bank. Cash equivalents are highly liquid investments that can be instantly converted into cash. Things such as short-term treasury bills, certificates of deposit, and commercial paper. Marketable securities are liquid investments which can be converted into cash within 90 days, such as stocks or bonds. Accounts receivable is the money owed to the company from its customers. For example, you might manufacture bicycles. You sell your bicycles to a local bicycle shop today, but the shop doesn't pay you for them until the end of the month. The money they owe you is an account receivable. Inventory is a company's products on the shelves or in its warehouse. They are the goods they want to sell to customers. Prepaid expenses is the money spent on goods and services that you haven't received yet. An example could be your insurance on your manufacturing plant. You might pay your policy at the start of the year and it covers you for the remainder of the year. This is a prepaid expense. Add up all your current assets and you get your total current assets. Assets which aren't expected to be converted into cash within the next 12 months are called non-current assets. Non-current assets are important for the long-term strategy of the company. Non-current assets include things such as long-term investments, property, plant and equipment, goodwill, and intangible assets. Long-term investments are investments in non-operating assets, such as buying shares in other companies. An example would be Berkshire Hathaway buying shares in Apple. Property, plant and equipment includes things such as buildings, land, manufacturing equipment, and office furniture. Property, plant and equipment is referred to as a tangible asset. Tangible meaning you can touch them. A note about property, plant and equipment is that it will often depreciate, meaning the value of the item will lose value over time and it will eventually be written off. Intangible assets are things you can't touch. This includes things such as licenses, trademarks, copyrights, patents, and brand. Intangible assets don't physically exist, but they still hold value. Take a brand name for example. Rolex can sell its watches at higher prices because its brand has value. Goodwill is a type of intangible asset, meaning it cannot be touched. Goodwill is created when one company acquires another company. Goodwill is the difference between the price paid for the company and the shareholder equity of the company. I talked about shareholder equity in my previous video. For example, let's say your company acquires the company Ned Skateboards for $100,000, but Ned Skateboards has shareholder equity of $90,000. The difference is $10,000. That $10,000 will be recorded on your balance sheet as goodwill. Add up all the non-current assets and you get your total non-current assets. Add up the total current assets and the total non-current assets and you get your total assets. Let's take a look at Nike's balance sheet. Here we have Nike's balance sheet as of 31st of May 2023. As you can see, the current assets are listed at the top. We have cash and equivalents, short-term investments, this is another name for marketable securities, accounts receivable, inventories, prepaid expenses, and other current assets. Other current assets is a catch-all bucket for other items which don't fit into the above. Add them all up and we get the total current assets. Next we have the non-current assets. First is property, plant and equipment. Next we have something we didn't cover earlier, Operating lease rights of use assets. An operating lease is the right to use an asset. Nike leases retail store space, certain distribution and warehouse facilities, office space, equipment, and other non-real estate assets. They do not own these assets, but the leases have value. Next, we have intangible assets, goodwill, and lastly, deferred income taxes. I think this should actually be a deferred tax asset. This means the company has overpaid on its taxes and should pay less tax next period. This is lumped in with other assets. Add up all the current and non-current assets and we get the total assets. As of 31 of May 2023, Nike has $37.5 billion in total assets. Let's summarize. Assets are the things the company owns that will provide a financial benefit in the future. Assets can be found on the balance sheet. Assets are listed in their order of liquidity. Assets can be split into current assets and non-current assets. Current assets are things which are expected to be converted into cash within the next 12 months. Current assets are important for the day-to-day operations of the business. For example, if you do not have enough cash to pay your employees, you may be forced to sell some of your other assets. Non-current assets are not expected to be converted into cash within the next 12 months. Non-current assets, such as property, plant, equipment, and intangible assets, are important for the long-term strategy of the company. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.